When you checked the Treasury markets this morning, you witnessed something that will be studied for decades. You saw the financial equivalent of a trusted ally turning away from the US dollar. You watched a partner unload massive quantities of American debt. The actor behind this isn't China, isn't Russia, isn't some adversarial nation facing sanctions. It's Japan, the nation America helped reconstruct after World War II. The nation defended by US military presence. The nation considered America's most reliable Asian ally. They've begun the largest coordinated American debt liquidation in modern history, and mainstream media is calling it a currency stabilization measure. That's inaccurate. This is a desperate survival action. This is an emergency liquidation. This marks the beginning of a transformation in the Treasury market as we know it. Let me walk you through what happened. On January 8th, 2026, at precisely 9:13 p.m. Eastern Time, the Bank of Japan issued a statement, not a press conference, not a televised announcement, a PDF document posted on their website in Japanese with a delayed English translation. The statement said they were evaluating measures to defend the yen. That's central bank speak. That's the language they use right before markets ignite. Within 70 minutes, overnight Treasury futures trading in Chicago began dropping sharply, not declining gradually, not selling steadily, dropping sharply. The algorithms detected the liquidity shift before any human analyst on CNBC even read the statement. By midnight Eastern, the 10-year Treasury yield had jumped 38 basis points. That's not normal volatility. That's a gamma event. That's what happens when a major holder stops buying and starts selling. And here's what they're not telling you on Bloomberg. Japan holds $1.1 trillion in U.S. Treasury bonds as of December 2025. That makes them the largest foreign holder of American debt, larger than China. China has been slowly reducing their holdings since 2022. They're down to $800 billion. But Japan kept buying. Japan kept supporting the auctions. Japan kept recycling their trade surpluses into treasury bonds because that's what allies do. That's what the post-1945 financial system was built on. We provide security. They fund our deficit. It's a bargain. That bargain just got ripped up and thrown away. Now, before we go further, I need you to understand something. The algorithm is trying to suppress this content right now. YouTube doesn't want this information on the front page because it undermines the soft landing narrative Powell is selling. You need to hit the like button right now, not later, not after you finish watching, right now. Because if this video doesn't break through the suppression algorithm in the first 30 minutes, it gets buried and nobody sees the information. Don't let them bury this. Hit like and push this into the public feed. Let me show you the numbers because the math is absolutely insane. Japan's currency, the yen, has been declining since the Federal Reserve started raising rates in 2022. In January 2021, $1 US bought 103 yen. Normal range. Stable. By October 2022, $1 bought 152 yen. That's a 47% decline in 21 months. The Bank of Japan tried to hold the line. They burned $62 billion in September 2022 trying to defend the currency. It didn't work. The yen kept falling. By December 2024, we were back at 157 yen per dollar. And now in January 2026, we just hit 163. That's a new multi-decade low. That's a currency in crisis. And here's why this matters. Japan is the world's third largest economy. They import everything. Oil, natural gas, food, raw materials, all priced in dollars. When the yen falls, their import costs explode. Inflation becomes severe. The population panics. And the Bank of Japan has exactly two choices. They can raise interest rates to defend the currency, or they can sell their dollar reserves to buy yen. But here's the problem. If they raise rates, they destroy their own economy. Japan's debt to GDP ratio is 264%. That's the highest in the developed world. Their government cannot afford higher rates. It would trigger a sovereign debt crisis. So they have to sell dollars. They have to dump treasury bonds. And that's exactly what's happening right now. Let me explain the mechanics, because this is where it gets dangerous. Japan doesn't just hold treasury bonds in a vault. They use them as collateral in the repo market. They rehypothecate them to fund their own banking system. When they sell treasury bonds, they're pulling collateral out of the global financial plumbing. That creates a liquidity cascade. The algorithms detect the collateral withdrawal. They front-run the next seller. The gamma flips. The volatility shock rises. And suddenly the entire treasury market is pricing in an emergency liquidation instead of orderly auctions. And the data shows this is already happening. Let me give you the proof. On January 9th, 2026, the U.S. Treasury conducted a 10-year note auction. Standard issue, $17 billion. The bid-to-cover ratio came in at 2.13. That's weak. That's below the 12-month average of 2.4. The indirect bidder participation, mostly foreign central banks, came in at 51%. That's the lowest since March 2020. Translation: foreign buyers are backing away from the auctions. And the primary dealers, and the big banks, required to buy whatever doesn't sell, got stuck with the rest. Those banks don't want to hold long-duration Treasury bonds in a rising rate environment. So they immediately hedge by shorting the futures. And that hedging pressure feeds into the algorithmic selling. It's a doom loop. Now let me contrast this with what China has been doing, because this is the geopolitical angle nobody is talking about. China has been quietly reducing their Treasury holdings since 2022, from $1.1 trillion down to $800 billion. But they did it slowly. They did it over 3 years. They rotated the proceeds into gold, commodities, and BRICS infrastructure projects. It was strategic. It was measured. Japan doesn't have that luxury. Japan is being forced to sell in size and in compressed time frames because their currency is collapsing in real time. This isn't a strategic rotation. This is a financial emergency. And here's the part that should terrify you. If Japan sells $1.2 trillion in Treasury bonds over the next 12 months, somebody has to buy them. The Federal Reserve isn't buying. They're doing quantitative tightening. They're shrinking their balance sheet. The European Central Bank isn't buying. They have their own sovereign debt crisis with Italian spreads widening. China isn't buying. They're selling. So who's left? Domestic buyers, U.S. pension funds, U.S. insurance companies, U.S. retail investors, and they'll only buy if the yield is high enough to compensate for the risk. That means yields have to go higher, much higher. When you checked the Treasury markets this morning, you witnessed something that will be studied for decades. You saw the financial equivalent of a trusted ally turning away from the U.S. dollar. You watched a partner unload massive quantities of American debt. The actor behind this isn't China, isn't Russia, and isn't some adversarial nation facing sanctions. It's Japan, the nation America helped reconstruct after World War II, the nation defended by U.S. military presence, the nation considered America's most reliable Asian ally. They've begun the largest coordinated American debt liquidation in modern history, and mainstream media is calling it a currency stabilization measure. That's inaccurate. This is a desperate survival action. This is an emergency liquidation. This marks the beginning of a transformation in the Treasury market as we know it. Let me walk you through what happened. On January 8th, 2026, at precisely 9:13 p.m. Eastern Time, the Bank of Japan issued a statement. Not a press conference, not a televised announcement, but a PDF document posted on their website in Japanese with a delayed English translation. The statement said they were evaluating measures to defend the yen. That is central bank speak. That is the language they use right before markets ignite. Within 70 minutes, overnight Treasury futures trading in Chicago began dropping sharply. Not declining gradually, not selling steadily, but dropping sharply. The algorithms detected the liquidity shift before any human analyst on CNBC even read the statement. By midnight Eastern, the 10-year Treasury yield had jumped 38 basis points. That's not normal volatility. That's a gamma event. That's what happens when a major holder stops buying and starts selling. Here's what Bloomberg isn't telling you. Japan holds $1.1 trillion in U.S. Treasury bonds as of December 2025, making them the largest foreign holder of American debt, larger than China. China has been slowly reducing its holdings since 2022 and is now down to $800 billion, but Japan kept buying. Japan kept supporting the auctions. Japan kept recycling their trade surpluses into Treasury bonds because that's what allies do. That's what the post-1945 financial system was built on. We provide security, they fund our deficit. It's a bargain, and that bargain has just been ripped up and thrown away. Japan's currency, the yen, has been declining since the Federal Reserve started raising rates in 2022. In January 2021, one US dollar bought 103 yen. By October 2022, $1 bought 152 yen, a 47% decline in just 21 months. The Bank of Japan tried to hold the line, spending $62 billion in September 2022 to defend the currency. It didn't work. The yen kept falling. By December 2024, it was back at 157 yen per dollar, and now in January 2026, it has hit 163, a new multi-decade low. This is a currency in crisis. This matters because Japan is the world's third largest economy. They import everything: oil, natural gas, food, raw materials, all priced in dollars. When the yen falls, import costs explode, inflation surges, and the population panics. The Bank of Japan has only two choices: raise interest rates to defend the currency or sell dollar reserves to buy yen. But raising rates would destroy their own economy. Japan's debt to GDP ratio is 264%, the highest in the developed world. Higher rates would trigger a sovereign debt crisis. So they have no choice but to sell dollars and dump Treasury bonds. And that's exactly what's happening now. The mechanics make this dangerous. Japan doesn't just hold treasuries in a vault. They use them as collateral in the repo market and rehypothecate them to fund their banking system. Selling treasuries pulls collateral out of the global financial plumbing, creating a liquidity cascade. Algorithms detect this withdrawal, front-run the next seller, gamma flips, volatility spikes, and suddenly the entire treasury market prices in an emergency liquidation instead of orderly auctions. The data confirms this. On January 9th, 2026, the U.S. Treasury conducted a standard 10-year note auction for $17 billion. The bid-to-cover ratio came in at 2.13, below the 12-month average of 2.4. Indirect bidder participation, mostly foreign central banks, came in at 51%, the lowest since March 2020. Foreign buyers are backing away. Primary dealers required to absorb the rest, hedge by shorting futures, and that pressure feeds algorithmic selling. It's a doom loop. China, by contrast, has been reducing treasury holdings slowly and strategically, rotating proceeds into gold, commodities, and BRICS infrastructure projects. Japan has no luxury of time. Their currency is collapsing in real time. This isn't a strategic rotation. This is a financial emergency. If Japan sells $1.2 trillion in treasuries over the next 12 months, someone has to buy. The Federal Reserve isn't buying. They are shrinking their balance sheet. The European Central Bank isn't buying. They face their own sovereign debt crises. China isn't buying, they're selling. That leaves domestic buyers, pension funds, insurance companies, and retail investors who will only buy if yields compensate for risk. That means yields must rise sharply. History shows the danger. In 1971, Nixon closed the gold window when foreign central banks drained Fort Knox. The Bretton Woods system collapsed. In 1985, the Plaza Accord forced Japan to appreciate the yen, triggering the asset bubble in the lost decades. In 2008, Lehman Brothers collapsed when repo markets froze due to insufficient collateral. Every crisis involved liquidity stress, collateral problems, and emergency liquidation. We are watching history repeat itself in real time with Japan and treasuries. The treasury market is massive, $24 trillion in outstanding debt, but liquidity is uneven. Most activity happens in on-the-run bonds. Older off-the-run issues trade thinly. When Japan starts selling, algorithms detect urgency and volume, short futures, buy puts on TLT, and force gamma flips. Market makers hedge by selling more bonds. It amplifies until something breaks. The Federal Reserve has an implicit target for the 10-year yield, somewhere between 4.2 and 4.6%. The market is already at 4.7%. If Japan pushes yields above 5%, the Fed faces a catastrophe. Let yields rise and mortgages hit 8%, corporate borrowing costs explode, zombie companies default, credit freezes, and the S&P collapses. Intervene, and the Fed restarts quantitative easing, undermining the dollar, sending gold and Bitcoin soaring, and triggering foreign exit from treasuries. This is worse than China selling. China is a geopolitical rival. Their selling is framed as hostile. Japan is an ally. When an ally sells, it signals desperation, and desperation is contagious. South Korea, Taiwan, the UK, all watch. The message is clear. Treasuries may no longer be a safe haven. When everyone thinks about exiting simultaneously, liquidity evaporates. Japan holds $1.1 trillion in treasuries. 10% liquidation equals $110 billion. Average daily treasury volume is $600 billion. That's manageable if spread over weeks. If selling compresses into days, yields spike, forced selling multiplies, and the market could face $500 billion in effective selling pressure as positions unwind. Behind the scenes, the Bank of Japan is calling the Federal Reserve and U.S. Treasury to expand currency swap lines, emergency liquidity. The last major activation was in March 2020 during the pandemic panic. This is supposed to be a normal market environment, but it isn't. Japan is being forced into this position partly because of U.S. monetary policy. For over a decade, zero Fed rates created the largest carry trade in history. Investors borrowed yen at near zero rates and invested in U.S. assets. When the Fed hiked in 2022, that trade unwound violently, forcing asset sales and yen repurchases. Japan is trapped in the middle, managing a currency buffeted by policies that are not its own. This is the hidden cost of dollar hegemony. Countries like Japan lose independent monetary policy. When imperial monetary policy conflicts with survival, vassals must choose. Japan is choosing survival. They are choosing their currency over treasury holdings. That choice will reshape global markets. In 1997, the Asian financial crisis began when Thailand floated the baht, which collapsed. Contagion spread to Indonesia, South Korea, and Malaysia. History is repeating, and Japan's treasury liquidation could be the trigger. The IMF had to step in with bailout packages. But the real damage wasn't in Asia. The real damage was in the U.S. hedge fund industry. Long-term capital management, the most sophisticated hedge fund on the planet at that time, had massive positions in emerging market debt and interest rate spreads. When those spreads blew out during the crisis, LTCM lost $4.6 billion in 4 months. They were about to default on hundreds of billions in derivative contracts. The Federal Reserve had to orchestrate a private sector bailout to prevent a system-wide collapse. And that crisis started with a single currency in Thailand. Now imagine what happens if the crisis starts with Japan. Japan is the third largest economy on the planet. Japanese banks hold trillions in cross-border liabilities. Japanese companies are deeply integrated into the global supply chain. If Japan's currency crisis escalates into a sovereign debt crisis or a banking crisis, the contagion will make 1997 look like a rehearsal. And the Federal Reserve doesn't have the same tools anymore. They already expanded the balance sheet to $9 trillion during the pandemic. They already did zero rates. They already did unlimited quantitative easing. The ammunition is spent, and the next crisis is going to require even more intervention, which means more currency debasement, which means more inflation, which means more panic from foreign central banks who are holding depreciating dollars. It's a doom loop, and we're in the early innings. The Japanese selling has just started. The Treasury auctions are just starting to show weakness. The bid-to-cover ratios are just starting to decline. The algorithms are just starting to position for the gamma flip. And the mainstream media is still telling you that everything is fine, that this is just normal volatility, that the Fed has everything under control, that you should stay calm and keep buying the dip. I need you to understand something. I don't know how long this channel stays live before they shut it down. YouTube doesn't like content that challenges the official narrative. They don't like videos that tell people to prepare for a financial crisis. They want you watching cat videos and consuming advertisements. You need to be subscribed with notifications turned on if you want to get the warning before the banks close the doors. Because when this crisis goes hot, when the emergency liquidations accelerate, when the margin calls start cascading through the system, you won't have time to react. If you're waiting for CNBC to tell you what to do, you're already too late. You need to be ahead of the curve. You need to be subscribed to this channel so you get the information in real time. Hit the subscribe button right now and turn on the bell notification. Don't wait. Now, let me walk you through the timeline of how this escalates, because this isn't a one-day event. This is a multi-month process. Phase 1 is what we're in now, quiet selling. Japan reduces their treasury holdings by 50 to 100 billion over the next quarter. The market absorbs it, but yields drift higher. The media ignores it. Phase 2 is when the selling accelerates. Japan dumps 200 billion in a single month. Yields spike. The algorithms panic. Volatility explodes. The VIX goes from 15 to 35. The media covers it, but frames it as bond market volatility without explaining the cause. Phase 3 is when other foreign holders join the selling. South Korea reduces their position, Taiwan reduces their position, the United Kingdom reduces their position. Now you have 500 billion in coordinated foreign selling. The Treasury market breaks. Yields on the 10-year hit 5.5%. Mortgage rates hit 8.5%. The housing market freezes, the credit market freezes. The Fed is forced to intervene. And phase 4 is when the Fed restarts quantitative easing and admits that the Treasury market can't function without central bank support. That's the end game. That's when the dollar loses its reserve currency status, not through some official announcement at a global summit, through market action. Foreign central banks stop recycling their surpluses into Treasury bonds. They buy gold. They buy commodities. They build BRICS payment systems to bypass the dollar. And the U.S. is left funding a $2 trillion deficit with domestic buyers who demand higher and higher yields. That's debt monetization. That's the Weimar playbook. That's the end game for every empire that debases its currency to fund its deficits. Now, let me give you the Brazil parallel, because this is what happens when a country loses control of its bond market. In the 1980s, Brazil had runaway inflation because they kept printing money to finance government spending. By 1990, inflation hit 2,900%. The currency became worthless. People stopped accepting it. They switched to dollars. They switched to hard assets. The government lost control. They had to create a new currency, the real, in 1994, and peg it to the dollar to restore confidence. It took a decade to stabilize, and that was a mid-tier economy. Imagine what happens if the United States, the issuer of the global reserve currency, faces a similar crisis. There's no higher authority to peg to. There's no IMF bailout package big enough. There's no lender of last resort for the lender of last resort. And this is why the Japanese selling is so significant. It's not just about 1 trillion in treasury bonds. It's about the signal it sends. It's about the precedent it sets. If Japan, the most loyal U.S. ally in the post-war era, is forced to dump treasury bonds to save their currency, what does that tell China? What does that tell the Saudis? What does that tell every other foreign holder? It tells them that the Treasury market isn't the safe haven anymore. It tells them that U.S. fiscal policy is out of control. It tells them that the Federal Reserve is trapped between inflation and deflation with no good options. And it tells them to start planning their exit. Now, let me show you what the smart money is doing, because this is the part that the retail investor doesn't see. The hedge funds are shorting long-duration Treasury bonds. They're buying TBT, the double inverse 20-year Treasury ETF. They're buying puts on TLT. They're positioning for a gamma flip where yields spike and bond prices collapse. The sovereign wealth funds are rotating out of Treasury bonds and into gold. The data shows that central bank gold purchases hit a record in 2023 and 2024, over 1,000 metric tons per year. That's double the historical average. They're not buying gold because they like shiny metal. They're buying gold because they don't trust the dollar anymore. They don't trust the Treasury market anymore. They're diversifying their reserves away from dollar-denominated assets. And the really sophisticated players are buying physical silver because silver is the most undervalued asset in the precious metals complex. The gold to silver ratio is currently sitting at 88:1. The historical average is 60.1. During monetary crisis, that ratio compresses to 15.1. If we just revert to a 60.1 ratio, silver has to double while gold stays flat. If we hit a crisis ratio of 15:1, silver goes up 6 times. And unlike gold, which is primarily a monetary metal, silver has industrial demand. Solar panels, electric vehicles, 5G infrastructure, military applications. The U.S. military cannot build missiles without silver. The deficit between mine supply and total demand is 200 million ounces per year. That deficit is being filled by above-ground stockpiles. And those stockpiles are shrinking. At some point, there's no more inventory to draw from, and the price has to spike to ration demand. But you can't buy silver at the conch price. You can't buy gold at the conch price. Go to your local dealer right now and ask them what they're charging for silver eagles or gold eagles. The premium over spot is $4 to $6 for silver. The premium over spot is $80 to $100 for gold. That's the difference between the paper price and the physical reality. The COMEX is a price discovery mechanism for paper contracts. Only 1% of contracts result in physical delivery. The price on the screen has nothing to do with the actual supply and demand for physical metal. The derivatives market is used to suppress the price. Japanese households hold more physical silver than the official reserves of most countries. When the yen falls, they buy silver. They store it in private vaults in Tokyo. They understand what's coming. They're not speculating on the COMEX. They're buying physical and holding it. It's a paper market, and the leverage is extreme. The COMEX silver contract is 5,000 ounces. Total open interest is around 150,000 contracts. That's 750 million ounces of paper. The registered inventory that's available for delivery is around 60 million ounces. The leverage ratio is 12.5 to 1. If just 10% of contract holders demand physical delivery, the entire system collapses. There's not enough metal to deliver, and the COMEX would have to declare force majeure, settle contracts in cash instead of metal. That's when the paper market decouples from the physical market. And anyone who's prepared by owning physical metal will see massive gains, while paper contract holders get cash settlements at suppressed prices. And you need to understand that the mainstream media won't tell you this is happening until after it's over. They'll call it a market dislocation. They'll blame speculators. They'll propose new regulations. But they won't tell you the truth, that the system was always fraudulent, that the leverage was always unsustainable, that physical metal was always underpriced relative to paper metal. Let me tie this all together, because the big picture is this. Japan's monetary policy is being forced to sell Treasury bonds to defend the yen. That selling is going to push Treasury yields higher. Higher yields are going to put pressure on the Fed. The Fed is either going to let yields rise and risk a deflationary shock to the economy, or they're going to restart quantitative easing and admit inflation isn't under control. Either path leads to currency debasement. Currency debasement leads to more foreign central banks exiting Treasury bonds. More exits lead to more selling pressure. More selling pressure leads to higher yields. Higher yields lead to economic damage. Economic damage leads to Fed intervention. Fed intervention leads to more money printing. More money printing leads to inflation. Inflation leads to loss of confidence in the dollar. Loss of confidence in the dollar leads to a global rotation into hard assets. Gold, silver, commodities, real estate, anything that can't be printed. And when that rotation accelerates, when the stampede toward the exit intensifies, the Treasury market won't function anymore. The government won't be able to fund its deficit at reasonable rates. The Fed will be forced to become the buyer of last resort. And that's when the dollar loses its global reserve status. Not through some official announcement at a global summit, through market action, through countries quietly building alternative payment systems, through central banks quietly diversifying into non-dollar assets. through investors quietly exiting dollar-denominated assets. It's already happening. The Japanese selling is just the latest and most dramatic example, and you need to understand that the mainstream media won't cover this as a crisis until it's too late to act. They'll downplay it, they'll call it normal market operations, they'll interview experts who will tell you everything is under control, and then one day you'll wake up and your retirement account will be down 40%. Your purchasing power will be cut in half. Your dollar savings will be worth significantly less. And you'll wonder why nobody warned you. But somebody is warning you. I'm warning you right now. The data is clear. The trend is unmistakable. The timeline is accelerating. Japan is selling. Other countries will follow. The Treasury market will break. The Fed will intervene. The dollar will debase. Hard assets will explode in value. The only question is whether you'll be positioned correctly when it happens. Go to your local dealer, check the prices, look at the premiums, try to buy size. You'll find that physical metal is already disappearing. The dealers are running back orders. The premiums are expanding. The disconnect between paper and physical is already happening. This isn't speculation. This isn't fear-mongering. This is data. This is math. This is history repeating. Because empires always end the same way, by debasing their currency to fund their deficits until confidence collapses and people rush toward real value. We're watching it happen in real time. Japan's selling is the catalyst. What comes next will be studied for generations. Position yourself accordingly.